Good evening. Last few classes we have been discussing secondary market or the stock market. So we have discussed some of the important fundamental concepts, which includes what a stock exchange is, what are the various functions performed by the stock exchange, and how to do trading on stock exchange, how to place an order, what is the trading mechanism, how settlement happens in the stock exchange, the settlement process in the stock exchange. Then we have also discussed uh, the governance and the functioning of stock exchanges, which includes the management team, the criteria for membership. So these are some of the concepts what we have discussed pertaining to stock exchanges. In today's class, we will discuss what comes before the stock exchange or what comes before the secondary market. So secondary market is actually an auxiliary support given to the primary market. Primary market is the broader market, and secondary market only acts as an avenue that provides liquidity for the trading that happens in the primary market. So I was just going through the concepts which are included in your material, and some of the concepts we have already discussed, as you can see here, and some we will begin the discussion in today's class. So today we will be primarily discussing about the security market. So security market, which includes primary market, its functions, methods of selling securities, what are the new instruments. So these are the concepts probably we'll discuss in today's class and in tomorrow's class. Some concepts probably you have studied in your previous semester also, but as I said, since you are studying most of the papers and all the papers are finance, so here and there will be few repetitions. So let's talk about the security market. Well, the commonly used terminology for security market is financial markets. Security market becomes slightly a narrow term, but the wider term is financial market. So let's discuss what financial market is. And the word financial market, right, can be easily interpreted provided you understand the basic meaning of market. So what happens in the context of a normal definition of a market is that it's an avenue which facilitates buying and selling. So buyers and seller meet, they exchange goods and services. So that's the basic definition of a market. Market is a location where buyers and seller come into contact to exchange their offerings, right? So some of the essential attributes of a market is existence of an area, which by and large now has become obsolete on account of improvement in the technology. Now, on account of technology, you don't need to have a physical place as such. Buying and selling can also be done virtually. Another important dimension is that you need to have buyers and sellers, and buyers and sellers should have an offering popularly called as a commodity, and competition is one of the essential feature of any perfect market, and also price consideration. It's a benchmark, so it's the value for the goods and services which is on the offering. So similar to a normal market, we also have financial market. So financial market, if you look at the definition here, the definition which I have used is a comprehensive definition. uh, we will also discuss some of the simpler definition little later, but this definition actually gives us the boundaries, the scope as to what happens exactly in a financial market. So financial market is a market in which people and entities. So people and entities, there are two different terms which are being used here. So when we say people, it is like people like me and you, the individuals. And when we say entities, so entities is a broader term which covers the corporates, various forms of organization, the government, right? So entities includes primarily the government and the corporate world. So in financial market, who are the participants? Who are the people who trade? Who are the people who are trading in financial market? The answer is it is the individuals and the corporates, right? And of course, it also includes government. So here the word entities denotes corporates and government. So these people and entities, what exactly they do in the financial market? The answer is they trade financial securities, and that's one of the reason why this is also known as securities market. What is being traded is a securities here, so that's the reason the word securities market is used, right? In fact, we are not studying the other components in your syllabus. We don't study commodities and other fungible items, and that's perhaps why the subject has also been named as securities market operation. So financial market is an avenue in which people and entities trade. What exactly they do trade in? So when we say trade, it primarily means buying and selling. So what do these entities and people buy and sell? Point number one, they buy and sell financial securities. Second, they also trade in commodities. And third, fungible items. So now we have to understand these three terms. What exactly do you mean by financial securities? What do you mean by commodities? And what are these fungible items that are traded in the financial markets? So financial securities indicates financial instruments. Financial instruments like shares, debentures, bonds, derivatives. These are financial securities. So why it is called a security? Why it is called a security? Right? Alternatively, we also use the word instrument, but security is also a very popularly used word in the legal language. Right? Now, when we say financial security, most of the financial securities are documentary claims, which means it's a paper in which the company acknowledges your investment. It's a paper, right? So when you go and do a fixed deposit in a bank, whether it is for a small amount or for a big amount, there is an acknowledgement issued by the bank stating that you have opened a fixed deposit and the duration of the fixed deposit and what is the amount you have deposited and what are the terms and conditions. So that document issued by the financial institution or bank serves as a document for you. It becomes an acknowledgement for you that you have invested in the fixed deposit, which also acts as a security because that's the proof that you have invested your money in the fixed deposit. So this proof issued by the bank in the form of a document or a paper is termed as a financial instrument. Similarly, companies also under their common seal, under the seal of the company, whenever you buy bonds, debentures, you get a document. So that document is an acknowledgement of your investment in the company. But of late, the concept of physical documents has disappeared. Now, these physical documents are converted into virtual entries or DMAT format, right? So dematerialized format. All the claim in the form of documents is now in the form of virtual entry. So when you buy a share, you don't get a physical share certificate issued by a company, but there was a time when investors used to get the certificates. But now the same entry is passed in your DMAT account, dematerialized account, stating that you have bought so many shares and the shares is credited to your account. So that credit indicates that you are a shareholder of a particular company, right? So that is also a documentary evidence, an acknowledgement, but here it's not in the written form, it is in the virtual form. So if you have to simply explain what is a financial security, the answer is it is the claim of the investor in the company represented in the form of a document, which can be a physical document or it can be a virtual document. So that's the reason it is called a financial security, right? Then you also have commodities, but commodities in financial markets are not traded the way the trading happens in a retail store, right? So commodities are basically in the raw form, which are extracted from the nature, right? So commodities includes your agricultural commodities, metals, minerals, right? All these are examples are all these examples represents commodities, right, which are basically in the natural form extracted from the nature. Some can be consumed directly, some cannot be consumed. It requires further processing. So in financial market, do we trade commodities also? The answer is yes. It's not just the shares, debentures, bonds, the financial securities what we trade, but we also trade commodities. In fact, India also has exclusive commodities markets, right? So MCX, multi commodity exchange, NCDX, right? So these are some of the popular commodity exchanges also. So financial market represents not just the share market, but also commodities market. But in commodities market, trade does not happen the way normally we buy products from a retailer. So I can't go to a commodities exchange or a stock exchange and tell them that I need to buy 10 kilos of rice. I want 10 barrels of crude oil. So we cannot physically trade commodities the way we do in a retail store. And the manner in which we do the trading also, it does not happen like this. Here the commodities are traded in the form of standardized contracts, also known as derivatives, right? So you can't go to a commodity exchange and say, please give me 1 kilo of rice, right? So it's not that kind of trading what we do in a store. So here the trading happens in the form of standardized contract. So sometimes these standardized contracts are physically settled. Sometimes only the cash settlement happens. So what it means is that most of the time the commodities are traded not physically, but in terms of cash. So people don't buy and sell commodities, but the trade happens on the prices of commodities, which means the trading is done on an underlying commodity, but actual commodity is not bought and sold, but the settlement happens in terms of the price differences. And in fact, this semester you also have financial derivatives as one of your subjects. And in financial derivatives, you also study in detail about commodities, right? So commodity derivatives are very popular these days. So there you will study more in detail about commodities. So all you have to understand is even though commodities are consumed by us in some or the other way, but we don't buy commodities the way we buy it in stores. But here the trading happens in the form of standardized contracts, and most of the time it is the cash settlement. So the trading happens on the price of the commodity, not the actual commodity, right? So we can do trading on the price of crude oil, we can do trading on the price of gold, silver, right? So actually when the settlement happens, we don't have to buy and sell silver, gold or crude oil, but the settlement happens in terms of cash, right? Popularly known as derivative contracts. And other fungible items. So it's not just the shares, it's not just the commodities like crude oil, energy resources like again, crude oil is also an energy resource, right? But here in fungible items, fungible means something that can be exchanged for some other thing, right? An item which can be exchanged in terms of another item. So when we say fungible items, it also includes forex market. So when we say financial market, it's not just the share market, not just the commodity market, but it also includes foreign exchange. So foreign exchange market is also a worldwide market in which transactions in currencies happen, right? So this is what a financial market is. A financial market is a comprehensive term in which people trade, right? In which trading happens. Trading of what? Three things: securities, commodities, and fungible items. And in order for the trading to take place, there is a transaction cost involved, which means if I want to participate in this financial market, there is a transaction cost. So if I want to buy and sell shares, I have to pay brokerage commission to my broker. So that also is a very good example of transaction cost, right? And the entire financial market, right, works on the mechanism of demand and supply. So the prices of shares, the prices of commodities, right? In fact, your foreign exchange, the fluctuation purely happens on account of variation in the demand and supply. If the demand is higher than supply, then the prices shoot up. But if the supply is more than demand, then the prices fall. So this is the mechanism on which the prices in financial market works, right? So this is a comprehensive definition of financial market. And this diagram, which might sound a little confusing, because when we see on the left and the right, we more or less have the same entities, right? You see here we discussed something called as people and entities. So who are these people and entities? This diagram represents those people and entities. So when we say entities, it means business and government. And when we say people, it represents individuals like us. So what does financial market do? The answer is financial market facilitate borrowing and lending. That's a simple definition of financial market. Financial market is an avenue that facilitates borrowing and lending. So if you look at borrowers and lenders are more or the same, right? So what happens is the lenders, right? So in case if I have some cash and I want to make a deposit, I go to a bank, right? And I keep my savings there in the bank. So what the bank will do, the same savings which the bank has received from me, the same money is given to business, government, and other individuals in the form of loans, right? So the bank becomes the connecting bridge between the lender and the borrowers. So financial markets, when we say, the examples of financial markets are your financial institutions, banks, non-banking financial corporations, stock markets, financial intermediaries. All these entities constitute financial market, right? So the funds are exchanged by issue of financial assets or instruments, right? So this facilitation of borrowing and lending. So this facilitation happens by issue of financial instrument or financial security, right? But as I mentioned, over the period of time, things have changed on account of technological advancement. Now, financial market may have a specific location or it may not have a specific location. So let's say Monday morning, I walk into ICICI Bank and apply for a personal loan. ICICI Bank is a financial market. Simple, right? So ICICI Bank represents financial market. I am the lender, sorry, I am the borrower, I'm borrowing money, and ICICI Bank is the lender, right? So how did ICICI Bank get that money from? Again, the money is being sourced from different entities, right? So ICICI Bank represents a financial institution, right? Now, most of you think ICICI Bank can be a financial institution, but can an individual also become a financial market? The answer is why not? Financial market is basically a term given for a financial transaction. So financial anywhere in the world, if a financial transactions takes place, it is deemed to have taken place in the financial market, right? In case if you're borrowing 10,000 rupees from your friend, right? Let's say you're working in a company and there one of your colleague says, "Yeah, I need 10,000 rupees immediately. I would return this to you after few days," right? And this dealing has happened in the washroom of the company, right? So now, is it wrong to say that the washroom of the company is a financial market? But as per the logic, it is, because financial market, the definition says that anywhere in the world where financial transaction takes place, it is deemed to have taken place in financial market. So that means the avenue where you decided to borrow and lend, that also becomes a financial market. The difference here is that your company's washroom is not regulated by any regulator. Whereas when I go and borrow money in ICICI Bank, there is a regulator who's monitoring, who is controlling the transaction. But here in washroom, there is no regulator as such. And you people have also not entered any agreement, right? So there is no agreement to borrow and lend. It's just a word of mouth. But that is also financial transaction. That is also financial market. The only difference is that if you go and take the same money from ICICI Bank, it becomes an organized financial market. But if you do this transaction anywhere else at your home, in the washroom, on the road, it becomes unorganized financial market, right? So we'll talk about this organized and unorganized financial market. But for now, if you have understood what a financial market is, I think that's more than sufficient for us to move to the next concept. So let me repeat, financial market is an avenue that facilitates borrowing and lending. And this borrowing and lending happens through financial securities or financial instruments, right? So let's talk about the different classifications of financial market anywhere in the world. It's not just in India, anywhere in the world. This is how financial markets are broadly classified. So they're either as financial market or unorganized financial market. By and large, India used to be a highly unorganized financial market, but slowly, for on account of various initiatives taken by the government is making financial market more and more organized. But still, by and large, India's financial markets remains highly unorganized, right? So the transactions that happens between your friends will come under unorganized market. Unorganized market, there is no regulations as such. It's all about personal terms and conditions. There is no monitoring. It's not that unorganized financial market is illegal. It is just that there's no regulations here, right? On the other hand, organized markets are regulated by the government, right? So that's one of the criteria. One of the criteria is regulation. Another criteria is registration. Organized market, the corporations, the financial institutions are registered, right? They are registered under GST, they are registered under Companies Act, they are registered under Partnership Act. But here in case of unorganized market, they are not registered under anything, right? Now you would have seen in India, we have the small financiers. They'll give you a micro loan and every day they'll come and collect money from you. So especially if you're a shopkeeper, this is quite popular, right? You can take loan from this financer. Every day you have to pay him, right? So in this case, there is no regulation. It's all about the mutual terms and condition. There is no RBI to regulate your transaction. There is that guy who's giving you money is not registered under GST, neither is paying any kind of taxes. So that's the reason it becomes unorganized. So that's a deciding factor. What is organized or unorganized? One is the regulation, the second one is registration, and the third one is the tax aspect. So there is no taxes here in case of unorganized markets. So this is the comprehensive picture of financial markets in India. Now all we have to do is we have to drill down and go a little more in detail and discuss the organized financial market. But let's quickly have a glance of the unorganized financial market, because India is made up of villages and small towns. Even though you may have banks in small towns, but by and large, in a village, you don't get to find any kind of bank. So who are the lenders there? So the lenders there are individuals, also known as indigenous bankers, right? So these indigenous bankers are small firms, or they're by and large individuals who basically lend money, right? Who basically lend money, and also they accept deposits, right? You can keep money with them and they'll give you some sort of a small interest. And this is what the India's financial markets mainly comprises of. They mainly comprises of indigenous bankers. But now over the period of time, government of India has decided to undertake financial inclusion. So as a part of financial inclusion, the objective is to ensure that most of the citizens in India have access to basic financial services. So one of the basic financial service includes opening a bank account. So every citizen should have a bank account, whether he's illiterate or illiterate. And that's one of the reasons why a couple of years back, Government of India came up with Pradhan Mantri Jan Dhan Yojana. The objective was to ensure that every Indian has a bank account. Whether the Jan Dhan Yojana was effective or not, whether did it serve the purpose or not, let's not discuss that. You are the person to come to a conclusion whether it did work or not. Prime Minister's Jan Dhan Yojana. But that's the broader objective of the government. The government wants everybody to have access to financial services, right? Because indigenous bankers are highly unregulated, and there's a lot of fraud, right? A lot of abuse that happens in case of unorganized financial markets, right? Most of you have seen in this movies, right? The sahukars or the landlords, they'll grab the land, they'll give loan, but later they don't return the land papers. So all sort of manipulation does happens in unorganized financial market, which the government, right, slowly wants to curb. So indigenous bankers have various instruments. So these instruments, what we say securities instruments, in local language, in unorganized market, they are called as hundis. And there are instruments for borrowing, and there are instruments for lending also, right? So both deposits also are there, loans are also available, right? So they are, even though these even banking system, when we look at the organized banking system, it is recently developed, but unorganized financial market is as old as human civilization, right? Is it exists from ages. So you might think that some of the instruments what you get to see now, these are the inventions of the modern banking system. The answer is no. Some of the financial instruments are as old as human civilization, right? A bill of exchange is one of the important document used in international trade. So this bill of exchange is actually not developed by the modern bankers, but they are rather developed by the indigenous bankers in centuries back, right? So what happens, this bill of exchange serves as a intermediary, right? So somebody else will take the responsibility of making payment in international trade. In international trade, one of the major risks, especially in import export, is the default party risk. You may place an order to buy 100 mobile phones from me. I am in India and you're from Sri Lanka, right? But after placing an order, what if at the last minute you can? So I have to suffer a huge amount of loss. Similarly, I may take advance from you. And what if after taking advance, I don't execute the trade? What if I default, I don't supply the goods to you? You will lose money. And we are sitting in two different countries. So I cannot go and register a complaint against you, right? In local police station saying that you have cheated me and you're in Sri Lanka. Indian police does not catch us thieves in our own country. How will they go and catch a thief in Sri Lanka, right? You know what is going on with Vijay Mallya right now. So therefore, there is a jurisdiction problem, right? Every country has their own sovereignty, so we cannot go and catch people from there and come back here, right? So that's not possible. It happens only in movies. So therefore, in order to solve this problem of default, indigenous banker during those olden days had come up with an instrument called bill of exchange, in which they will give the guarantee to both the parties. Which means if you are a person who is importing, you don't have to pay me till I supply the goods to you. Rather, you go and deposit that money in a bank. Bank will give you a document saying that if the moment you supply the goods, we will guarantee the payment to you. So now the issue is solved. See, this is an important instrument in export import trade, but this is not the invention of the modern banking system. It was invented by the indigenous bankers centuries back. So indigenous bankers have played a very important role, but it is just that indigenous bankers try exploiting, right? So some of the popular indigenous bankers are known by different names in different parts of India. So here you can see on the slide in Chennai, they are called Chettis. So the Chetty community basically are the one who serve as indigenous bankers. They give money, they give loans, right? In North India, they are called the Sahukars, Mahajan and Ketans. In Mumbai, they are called Shravs and Marwaris. In Bengal, they are called the Seth and Bania. So these are the true indigenous bankers. So this is what most of the rural India is made up of. Most of the rural India is made up of indigenous banker. You will not find HSBC and Citibank in a village, right? So these are the people who act as Citibank and HSBC in rural areas. So this is what most of the India is made up of, right? But let's try focusing on the organized market now, because you people have to study the organized market. But I just wanted to give you a perspective of what this unorganized market is made up of. So the organized market is made up of several segments, right? So the first is called the capital market, right? Now, what is capital? The term capital in business as well as in accountancy means money invested in business to generate income. On the other hand, market means an avenue that facilitates borrowing and lending. So two terms: capital, money required for the business; market, a medium to trade. So when we combine these two, right, term, we get the uh, real meaning of capital market. So capital market is a part of financial markets, right? And it's a market where the borrowing and lending. So capital market is also a financial market. What is a financial market? Financial market is where borrowers and lenders meet. Similarly, capital or market is also a financial market where borrowers and lenders are meeting. But why it is called capital market? Because the borrowing and lending happens for a long term. So capital market is a name given to a transaction where the borrowing and lending is for a long term duration. Now the question is, what do you mean by long term? What is, when we say long term, how many years it is? Is it years or is it decades or is it centuries? Right? So the basic classification says anything which is above 1 year is long term. So if you are going to ICICI Bank again, you're taking a 10 years loan. You're taking a 10 years loan. The transaction can be classified as capital market because it fulfills all the criteria which is given in the definition here. So it's a market for financial assets which have a long or indefinite maturity. Or in other words, capital market is a part of financial market where the borrowing and lending happens for a period which is more than a year. Or in some cases, it is infinite because here you see there's one term which says long or indefinite. Now you have to focus on the word indefinite because whenever borrowing and lending happens, you have to tell the lender when are you going to repay, right? If you're borrowing money from your friend and if your friend asks you when are you going to repay and if you say I don't know, do you think the borrowing and lending will happen? Before the transaction could take place, the deal will get cancelled because you have to clearly mention when are you going to repay the money, right? But in case of capital market, certain borrowing and lending transaction does not have any maturity period at all. Now, how is that possible? A very good example for this is shares. When companies issue shares to public, after the public subscribe for the shares. Now recently we had Burger King IPO in which Burger King had issued, I think, shares worth 830 crores to public and borrowed money from them, right? I don't know if you guys had applied for Burger King IPO, but now let's say I'm one of the lucky shareholders. I'm lucky, one of the lucky person who has got the shares of Burger King IPO, which most of the brokerage houses have given subscribe rating on account of good business prospects. It's not that the performance of Burger King is good at the moment. Right now, Burger King in a very introductory stage in India because there is already a big fish, McDonald's, which is well established and doing very good business in India. Burger King, on the other hand, is a late entrant, recently entered the market, but the market is already well established and there are already some of the big sharks in the market. In such a situation, to venture into a market which is highly competitive and to establish yourself, it will take time, right? So even though Burger King is not well settled, but the prospects seems to be very good, and most importantly, the shares were priced at a very good rate. So that's the reason most of the brokerage houses gave very good rating and asked people to subscribe because Burger King has a very good future prospects and the valuations are fair. The share price was rightly identified. So therefore, let's say you buy shares of Burger King and you got the share luckily at 90 rupees, right? And you have some 1 lakh shares. Assume that you have some 1 lakh shares. So you have invested, you get these shares, now you become a shareholder. Now after a week, you want that money back. Will you go to Burger King headquarters or will you go to a Burger King retail outlet and say, I am the shareholder, give my money back and take your shares? The answer is it does not happen in that way. Because once you become a shareholder, once a company issues shares to the public, that becomes a permanent capital. See, if your company borrows loan for 10 years, 15 years, 50 years, there is a maturity, it has to return it back. Same thing applies in case of debt instruments like debentures and bonds. After issuing debentures or bonds, wants the money. what should the investor do? The answer is invest and get the money back. So secondary market or the stock market provides liquidity to the primary market. In case if stock market does not exist, trust me, primary market will collapse, right? So primary market is there running efficiently. One of the reason is the stock market, because stock market provides liquidity for the shares purchased in the primary market, right? So that's the reason the word here indefinite is used, because some instruments like shares does not have a maturity period. That means companies who issue shares, they don't tell the investors, they don't tell the public when are they going to repay. They'll never repay also, because that becomes a permanent capital. And that's the reason why we have a stock market. So if you want your money back, find a buyer there in the stock market, sell the shares and get your money back, right? So in simple words, capital market is a market for long-term borrowing and lending. What is this long term? The answer is either more than a year or in some cases infinite period. Now this so-called capital market has been classified into three categories, and don't get confused and carried away. These are the terms given. They're just the terms given for the transaction. Suppose if a company is borrowing from capital market, it is called industrial securities market. Suppose if government is borrowing from capital market, it is called government securities market, right? BMRCL, Bangalore Metro Rail Corporation Limited, what is the source of funding? In order to carry out such a large scale project, right, which covers most of the Bangalore, different lines are being established. Where is the money coming from? So the funding is being done both by government as well as the World Bank, but government has done the funding, point number one. Second, BMRCL itself has borrowed money from public by issuing bonds. So BMRCL has issued 15-20 years bond, and it has borrowed money from public, and BMRCL is giving interest on those bonds. So BMRCL, right, is a company, right? So if the borrower is the government, then it becomes government securities market. Long-term loan market, the borrowers can be individual, government, or it can be in people like me and you, right? Individuals. So industry, government, or individuals. So don't get confused and think too much over these terminologies. Basically, these are the terms given for specific transactions. So all these terms are given based on who's the borrower. Borrower is a corporate, industrial securities market. Borrower is the government, government securities market. Simple, right? So this so-called capital markets, as I said, industrial securities market, which is again being classified into two categories: primary market and secondary market. And this is what you people have to discuss in detail. So primary market is a market for new issue of shares. That means when a company is issuing shares to the public, or when a company is issuing shares to public directly, it is called new issue market. When these shares are already subscribed, bought by public or the investors, when they buy and sell amongst themselves, then it is called secondary market, also known as stock market. So in simple words, primary market is C to I, company to investors. Secondary market is investors to investors. So who are the participants? Investors are trading amongst themselves. Whereas in primary market, the transaction is happening between a company and investors. So once an investor buys the shares from the company in primary market, he can't go back to primary market and sell it. He has to sell in the secondary market or the stock market and convert his investment into cash. So this is what a primary market is. So primary market is a part of capital market that deals with issuing of new securities, issuing of new shares directly to the public, right? So these are some of the important features which we can extract from the definition. So it is related to new shares. This is the market for long-term capital. Since primary market is a part of capital market, obviously it has to be long-term. Securities are directly issued from company to the investors. and the capital is raised. Why do companies access capital market? Why do companies borrow money from capital market? Either to start a new venture or to expand business operations. There are various reasons why the money is borrowed. And again, it has no specific place as such. So primary market is not a place. Primary market is a name given to a transaction, right? So it has no particular place as such, right? So how do you borrow money in capital markets? How do we borrow funds from capital market? So there is a mechanism to access capital market, right? And the mechanism is simple. You have to issue a financial instrument and then borrow the money, which means either you have to issue shares or you have to issue debt securities, which primarily includes shares and debt securities primarily includes debentures and bonds. So these are the two ways of borrowing money in capital markets, either by issue of shares or by issue of debt securities. So this is how you borrow money from capital markets. So let's wind up today's class by having a discussion on debentures. Right now, shares are quite popular, but let's understand the mechanism of as to how debentures work. Right, debenture is one of the most I would say efficient in terms of cost. It's a very cost effective source of funding to the bank. Now, what exactly happens in case of debenture is that how is debenture different from a bank loan? Let's discuss how debenture is different from a bank loan. Let's say you're a company who requires a capital of 50 lakh rupees. So you need 50 lakh rupees to invest in some new business proposal, right? So if you want to invest 50 lakh, if you want to invest 50 lakhs, of course you need to have source of funding. So you are contemplating on going for a bank loan, right? Now when you go for a bank loan, there are a set of challenges you have to face. First, bank will not give you loan unless you don't have a collateral. So bank will always say what is a security, what is a surety. So you have to pledge your assets and then go for a loan, right? Unsecured loans are not given by banks. Banks are very smart, but there are banks who also give you unsecured loans, but the rate of interest is exorbitant, right? There's a very high rate of interest. So first, there is an issue of collateral. Second, the interest rates are very high, right? And third, in case if you do not have any proper track record, if you do not have proper reputation, there are high chances that you may not get a loan. So you should also have a very good credit history, right? So these are some of the criteria what banks look for. But despite of having all this, let's say you have a very good credit history, right? Your credit scores are very good, right? Despite of all this, the only major setback here is that the rate of interest charged by banks are very high. Let's say I'm going to HDFC Bank to get a loan to invest in a new business proposal. Uh, HDFC Bank is convinced with my credit history. They are happy with my financials. The only issue I have is that they have asked me to pay an interest rate of 15%. So imagine 15% on 50 lakhs per annum. It's a huge amount of money, right? So interest itself becomes so huge. So when the interest rates are so high, how will you manage? That's a challenge. That means yearly you have to pay 7,50,000 interest. Only interest is 7,50,000. So is there any other ways of reducing this interest? The answer is yes. Debentures seems to be a viable option. What happens in debentures? You're not borrowing this 50 lakh rupees from one single financial institution, but you're borrowing this 50 lakh rupees directly from public, but not from one individual, right? So if you ask me, sir, will you invest 50 lakh rupees in my company? I will say was not possible. But if you ask me, sir, will you invest 1,000 rupees in my company? I may say yes, why not? 1,000 rupees is not a big deal. So what happens is this 50 lakhs, this 50 lakhs is broken into small units. Let's say 50 lakh, I am borrowing from 10,000 people, right? I am borrowing from 10,000 people. So if I borrow 50 lakh rupees from 10,000 people, that means from each individual I have to take only 500 rupees. So 500 rupees, borrowing 500 rupees from 10,000 people, quite an easy task. right? So if I'm giving 500 rupees to you, let's say it's 500 rupees, it does not mean that it's taken for granted. I will still ask you, okay, 500 rupees, what am I going to get? So if you say, sir, I'll give you 7%, sir. 7% means 35 rupees. 35 rupees, 7%. Okay, should I accept this offer? The answer is no, because your company is relatively new. I don't know your company at all, right? And second, we don't know what will be the future of your company. It's always a question mark. The same 500 rupees I go and keep in a bank, my money is 100% safe, and still I get 7%. So I will not invest in your company, because why should I? Because anyways, I can earn 35 rupees very safely by keeping my money in the bank account. So now what you do is you say that, okay, I'll give you 11%. Now 11% is very attractive, because now no banks will give you 11% interest. Now I'm willing to take risk for that extra 4%. I'm willing to take the risk. So even if you offer 11%, it is still a win-win situation, because had you borrowed the same money from a bank would have charged you somewhere around 15 to 18%, right? So you would have ended up paying 15 to 18% interest. Now for public, even if you pay 9 or 10%, you still end up saving a lot of money, right? So that's how a debenture works. In simple language, debenture is a loan which you're borrowing from the public, right? So it is an acknowledgement. Basically, when you borrow loan in the form of issuing debentures, you're giving a debenture certificate. Debenture certificate will have all the terms and conditions of borrowing and lending. It will acknowledge that you have deposited so much, when the company will return the money back, how much interest you will get, what are your rights, what if company defaults. So all those terms and conditions are mentioned, and the debenture certificate is issued under the common seal of the company, right? So debenture is nothing but a form of a loan taken directly from the public, right? So public also gets benefited, because as I told you, debentures carry an interest rate which is more than any other forms of interest rates. It's more than what a fixed deposit offers. It is more than what a savings bank account offers. It is more than what a public provident fund offers. So therefore, it's a win-win situation for both company as well as the investor. So tomorrow, most of you are salaried employees, right? So a lot of you find the easy way to park your surplus is FD, right? As per the research, the most popular avenue of investment, especially amongst Indian women, is jewelry. First of all, gold jewelry is not an investment, because something which you consume can't be considered as investment, but still it is considered as an investment. The second most popular avenue of investment amongst the working women is fixed deposit, because very easy. All you have to do is authorize the bank to take money from your account and keep it as a deposit. You get interest. So something which we don't explore is these instruments. So debenture is a very good instrument which can give you good amount of interest, more than your fixed deposit. So why not explore debenture? Why always think about fixed deposit, right? So debenture is also a very good avenue of investment, but of course it also has certain limitations which I'll tell you a little later, right? So these are some of the highlights, right? If a debenture, this is from the viewpoint of company, this is not from the viewpoint of investor, this is from the viewpoint of company. So first of all, there is no dilution of control. See, the issue with shares is that the more number of shares you issue to the public, you're losing control in your own company. If I'm issuing 100 shares, let's say I want 100 rupees. So I'm issuing 100 shares of 1 rupee each, right? From my side, I'm contributing 30. From the public, I am borrowing 70. Now, if I do this, who has more control in my company? The answer is whoever has more number of shares. Public has more shares in my company. It's my company. I don't have so many shares, but public has. So that means in my company, I don't have any control. So somebody else through voting rights can take complete control in my company, right? So that's the drawback of shares. The more number of shares you issue to public, you lose control in your own company. There are good amount of companies who have lost control. Infosys, promoters no longer have majority shares. Majority shares are held by the government. Sorry, majority of the shares are held by the shareholders. One of the major shareholder in Infosys is LIC, Life Insurance Corporation of India. So who has majority control in Infosys? Life Insurance Corporation of India, not the promoters who actually started the company, because most of the promoters have sold the shares and they have left the company, right? Narayan Murthy, his children, his partners, most of them sold the shares. So now the control is completely not in the hands of promoters, but in the hands of public. But that's not the case in case of debentures, because debenture does not offer voting right at all. First of all, debenture holder is not the owner of the company, unlike a shareholder who has voting rights and can be the owner of the company if he has majority shares. But debenture holders is not an owner, debenture holder is a lender. So there is no dilution of control. Second, the cost is low, right? It's a very cheap source of funding. Third, it's a long-term fund. It's not like for 6 months or few months. You can issue debentures even for decades also. 10-year, 15-year debenture can also be issued, right? The interest rate is less. So there are two terms. First is low issue cost, low interest rate. So these are two different things. Issue cost is also called as flotation cost, expenses incurred in borrowing the money. So when you issue debentures to public, the cost involved is very less. When you compare this with shares, for shares, the issue cost is very high because there are multiple expenses involved, which we shall discuss little later, right? So issue cost is less, interest rate is also less, and the interest what you pay to the debenture holders can be deducted from your profit and loss account. The moment you deduct an expense from profit and loss account, your profits will reduce and tax will also be less. On the other hand, when you pay dividend to shareholder, dividend is not a deductible expense, right? Dividend itself is a profit. So you can't deduct profit from profit. So dividend is nothing but profit given to shareholder. So you cannot say, okay, I've given dividend to shareholders, so I'll deduct from my profit, right? So these are some of the advantages of uh, debentures. But on the other hand, debentures also has some major limitations from the viewpoint of company. When you examine, there are some major problems also with issue of debentures. So we will have more discussion on this, since I have to also schedule a class for the other section. So we will have more discussion on debentures in tomorrow's class. And as